Understanding how to research a stock is the difference between being a winner or a loser in the market. And early on in my investing career, I was definitely on the losing side most of the time. But it was mainly because I didn't understand how to pick a stock in the first place. That is why today we'll be covering proven steps to analyze any stock and determine whether or not it's a buy. And we're starting right now. Before you read any articles or look at any charts, you have to understand what the business does, the value it provides to its customers, and how it makes money. One of Warren Buffett's foundational principles is built on this idea, and he often says, never invest in a business you cannot understand. And this doesn't mean you just have a general idea of the business, because everyone knows that Nike sells shoes. This means that you understand the inner workings of the business. You need to be able to answer questions like, how do they generate revenue? What is their business model? Who are their target customers? And what risks are there to the business? I've personally made mistakes investing in both the healthcare and security technology industries just because I read positive articles on certain stocks, but couldn't answer any of those important questions. Keeping this as a rule for yourself will save you from losing a lot of money. A good way to test your knowledge of a company is to try and explain it simply to a friend. Albert Einstein famously said, if you can't explain it simply, you don't know it well enough. If you can't explain what the company does and how it makes money without confusing your friend, you're in a pretty good spot. To be able to do this though, you're going to have to do some due diligence and research. So let's cover the best places to find this information. A couple of great places to start are the company's annual report and 10K documents. These are publicly released documents that are made to inform investors about the future plans of the company and the current state of the company. These documents are pretty similar, but the 10K usually dives into a bit more detail in terms of financial data, and it's the official document provided to the SEC, which is the organization that helps regulate the stock market. I would suggest reading both, but the 10K is a great place to start. So let's actually take a look at a 10K, using Tesla as an example. Finding a company's 10K is super easy. All you have to do is type in the company's name and 10K. If you haven't seen one of these before, it'll look a little bit overwhelming, but I promise the information is always very easy to find. Every 10K I've seen has this nifty table of contents at the beginning to point you in the right direction. The first thing we want to do here is click on business. This will bring us to a description of how the business works and how they make money. This section usually starts with an overview of the company, then goes product by product explaining what it is and how it provides value to the customer. So for Tesla, we can see that they design, develop, manufacture, sell, and lease high-performance, fully electric vehicles. They also provide energy generation and storage system services. They also explain that they are mostly a direct-to-consumer business model. The next area of the 10K you want to focus on is the financial statement. So you'll want to go to the table of contents and click on financial statements. In this section, you will find a breakdown of the company's revenue sources for the last 3 years, along with the percentage change year over year. So here, for example, we can see a majority of Tesla's revenue is coming from automotive sales, but they also have revenue coming from leasing, energy generation, and energy storage. We can see that revenue from car sales increased by 31%, which is mainly due to their ability to deliver more Model 3 and Model Y cars despite a temporary factory shutdown. We can also see their energy generation and storage revenues were up 30%, primarily because they increased the deployment of their Megapack battery. The last section you want to review in the 10K is the risk section. To get there, you want to click on risk factors in the table of contents. This is a great way to understand what the company sees as its short-term and long-term risks. So you can see here, Tesla says that a long-term risk is consumer demand for electric vehicles, along with increasing competition. According to Tesla, short-term risks include effects of COVID and controlling manufacturing costs. So now that we know how to go about understanding a business, where the revenue comes from, and the risks, let's take a look at how to analyze their financials. To find the financial information I'm looking for, I'll usually go to my brokerage account or just use Yahoo Finance, but you can also find this information on the 10K. The first key number I'm looking for here is revenue, which is how much money they generated. Then operating income, which measures the amount of profit realized from a business's operations after deducting operating expenses like wages and depreciation, etc. Next up is net income, which is income minus the cost of goods sold, expenses, depreciation, interest, and taxes. Then we have operating cash flow, which measures how much positive cash flow the company is producing, which will indicate how well it can maintain and grow its operations. Another one to take into account is free cash flow, which shows what is available to the company after all expenses are accounted for. This money can be used to pay down debt, redistribute among shareholders, or buy back shares. Higher cash flow tends to provide more flexibility to a company. Generally speaking, we want to see these numbers in the green and growing over time. This indicates that a company is headed in the right direction, is predictable, stable and manages its assets well. Lastly, it's important to take a look at the return on invested capital, or ROIC, as this demonstrates the company's historical ability to provide returns to its investors. And typically anything over 10% is considered very good. The next thing we want to take a look at is the price to earnings ratio, or PE ratio. This can be calculated by dividing the price per share by the earnings per share. The purpose of using this number is to determine the relative value of a stock. You can calculate this on your own, but most financial websites will have this displayed for you. In general, a high PE ratio suggests that investors are expecting higher earnings growth in the future compared to those with a lower PE ratio. A high PE ratio could also be an indication that a stock is overvalued. A low PE ratio could mean one of two things. Either the company may be undervalued or it's doing very well relative to its past performance. So you're probably wondering, what is a good PE ratio? Well, the PE ratio for the entire S&P hovers between 13 and 15 historically. I typically use this as a baseline and then compare the PE ratio of the stock I'm researching to others in the same industry. Next, we want to evaluate the size of the market that company is in and how much market share they currently have. I think this is really important because it's a good way to get an idea of the growth potential of a company in the long term. For example, I would never invest in a cigarette company like Philip Morris because the market for cigarettes is shrinking in the long term. So let's run through this exercise using Tesla again. First, to figure out the market size, all you have to do is research the name of your market followed by market size. So in this case, it would be the electric vehicle market. There will be a lot of articles on the topic, but generally I picked the first one. So here we can see the electric vehicle market is projected to be worth $2.5 trillion by 2027. We can also see that it's expected to grow fast at a compounded annual growth rate, or CAGR, of 34% per year. So now that we know Tesla is playing in a massive market, let's see what percentage of the market they currently have. All I need to do here is type in Tesla EV market share, and we can see that they own 79% of the US market and 11% of the total global EV market. This means that if Tesla can hold majority market share in the United States while also growing global market share, there is plenty of room in the EV market for them to grow even with additional competitors. One of the most important things to understand about any company you invest in is its competitive advantage. This is defined as a set of conditions or circumstances that puts a company in a favorable or superior business position. It's so important to understand the advantages because these are what help the company grow faster compared to its competitors, capture more market share, and increase the stock price. Warren Buffett once said, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage." If you understand the business already, it's likely that you know a few competitive advantages, but I would still recommend you do research on this to understand all of the competitive advantages and why they are important for the company's future. After a quick search on Tesla competitive advantages, we can see popular ones include their battery supply chain, supercharger network, and their automatic software updates. Now, if I was considering investing in Tesla, I would want to understand why each of these are competitive advantages and how hard it would be for a competitor to catch up to these. It's really easy to ignore this step when you're researching a stock, but reviewing the management team of a company is a must. One of the world's most famous investors, Mohnish Pabrai, once said, "Management is incredibly important. I've been burned many times when I didn't pay enough attention to that. Businesses are very fragile and most of them don't survive very long. Leadership, both depth of leadership as well as quality of leadership, matters a huge amount." The idea is that you're handing your money to these people, so you want to know about their past experiences and ability to grow the business and drive the share price up. It's super easy to find information on executive leaders. You can find ratings and reviews of CEOs on sites like Comparably or Glassdoor. When I'm researching the C-level management team at a company, I typically look for past experience and proof of success at a similar company in the past. To give you an example, I recently researched a stock called Upstart, ticker UPST. There were many reasons why I ended up deciding to buy shares, but a major reason was the experience of their management team. All of their founders have experience leading large teams at Google and have a long history in the tech industry. The CEO, David Gerard, led Google's enterprise business and has incredible reviews from employees and other leaders. This is probably the question that investors ask themselves most often. It's tricky because there are a few strategies to go about buying a stock at the right time. But the first step would be to add the stock you are considering to your watch list in your brokerage account. This way you can monitor it over time and get a sense for any patterns in the way that the stock moves. One common tool to use when deciding whether or not to buy a stock is called the 50-day moving average. This is the average of the share price over the last 50 trading days. It is commonly thought of as an important support level for stocks, meaning that if the stock is near or just below the moving average, it is historically rebounded from that price level. So if you see a stock near its 50-day moving average, you should watch it closely and consider buying up some of that stock. If the stock is way above its 50-day moving average, I wouldn't rush into buying shares. This average is super easy to find through a quick search. You also want to consider dollar cost averaging. This means that you buy shares over time instead of trying to time the perfect low point of the stock. It's almost impossible to buy a stock at the perfect time right before it rebounds. So a safe way to build a position in a stock is to buy a little bit at a time during a downward trend. This will protect you from missing out on potential profits if the stock rebounds before you expected. Since I'm investing for the long term, I'll typically look at the 1-month and 3-month trends of a stock, then compare that to its 5-year historical performance. I like to look for those that are in the red over a 1 or 3-month period, but have had strong growth over the 5-year period. I will usually buy a little at a time along the downward trend, then a bit more once it begins to rebound. So when should you sell a stock? Well, Warren Buffett famously says that his favorite holding period is forever. Historically, holding your stocks for a longer period of time gives you a better chance of beating the market over the long term. It allows for your portfolio to compound and doesn't expose you to short-term stock price drops. With that being said, not everyone can afford to hold a stock forever or wants to hold a stock forever. Sometimes you just need the cash, and sometimes you want to move money to another investment. Whenever I buy a stock, I plan on holding it for at least 3 to 5 years. In my opinion, this gives me the best opportunity to make money on every stock I buy. It leaves you protected from the periods where the stock may not perform well, but lets you take advantage of the times where the stock makes a huge run. So once you buy a stock, it's best to act like you don't even have that money available to you. Just remind yourself it'll be worth a lot more in a few years. So let's quickly review the key points from this video. You should never invest in a business you don't understand. You need to be able to answer questions like how do they generate revenue, what is their business model, who are their target customers, and what risks are there to the business. You need to understand the company's financials by looking at their revenue, operating income, net income, operating cash flow, free cash flow, and return on invested capital. Return on invested capital above 10% is considered very good. Reviewing a stock's PE ratio is key to understanding whether the stock is over or undervalued. This is calculated by dividing the price per share by the earnings per share. Generally speaking, the higher the PE ratio, the more likely the stock is overvalued. You want to know the projected growth and size of the market the company is in and understand how much market share they currently have. This gives you a basic idea if there is room for the company to grow in the long term. Every company you invest in has to have a competitive advantage. You need to understand that advantage and the company's chances of maintaining it, because this will be their best chance to win against their competitors over the long term. You always want to review the management team. Make sure they have past experience growing and building a business and have good reviews from employees and other leaders in the industry. Remember, you are giving these people your money, so make sure you trust them. When trying to find the right time to buy, it's important to leverage moving averages and dollar cost averaging. Compare the 1 and 3 month trends with the company's historical growth. If you see deep red recently but overwhelming growth over the long term, that could be a good time to buy. The best time to sell is never, but plan to hold a stock at least 3 to 5 years to give yourself the best chance at having a highly profitable investment. Thank you so much for sticking with me until the end. If you're interested in learning more about how to save money fast for your investments, check out this video on 7 of my favorite money saving tips. Have an amazing rest of your day, and I'll see you in the next video. Bye for now.